Hello everyone, this is Group 2 and I am Kimberly Mangubat. I am accompanied by my group members. So they are Vina Marie Gascon and she will tackle about the income statement, and also me and my co-partner Leah Dagatan will tackle about the balance sheet. And also Karen Rodriguez will tackle about the cash flow statement. And the last one is Mary Joy Kolyama will discuss what is the significance of cash forecasting with the financial statement, if there is a.
Good day. I'm Fina Marie Gascon from BSBA Major in Financial Management, and I'm going to discuss about the income statement. So, income statement is one of the core parts of financial statements because this represents the financial performance or the financial health of the company, where you will know if your company is getting or earning profit or experiencing losses. So, one of the parts of an income statement is the revenues, or also known as sales, which is the income received by the company in selling goods, products, or rendering services, while the cost of sales are representing how much costs in making those goods, products, or rendering services, such as labor and materials. The two accounts that can also be seen in an income statement are the gross profit and net income. So the gross profit is the income which only deducted by its cost of sales or the cost in making goods, products, and rendering services, while the net income is now the result of the gross profit deducted by the operating expenses or tax expenses of the company. It is like the final result, which now determine if the company is earning more profit or experiencing major losses. Another account that can also be seen in an income statement is the operating expenses. So these are the expenses that occur in doing business operations, such as salaries expense, equipment and supplies expense, rent and utilities expense, maintenance expense, advertising expense, and so on, which are all deducted in the gross profit. So when the operating expenses are now deducted from the gross profit, we will now get the net income before tax. So it is called the net income before tax because we didn't include the tax expense in the operating expenses, since we will determine first if the company is earning more profit or experiencing losses. If the company is earning more profit, then we will deduct the tax expense. But if it is experiencing losses, the tax expense is no longer can be deducted from the net income. That is all about the income statement. The accounts I've mentioned before are all parts of it. So it is indeed important in a business because it is used to determine the financial performance or financial health of the company. Therefore, it will help the business owners or investors in determining what is wrong, if there is any wrong in the financial statement, or if the company is doing well or not.
Hi everyone, this is Kimberly Mangubat and I will tackle about the balance sheet. So before we discuss about the parts of balance sheet, let me give you an insight what is balance sheet. So a balance sheet it summarizes company's assets, liabilities, and shareholders' equity at a specific point in time, as indicated at the top of the statement. So it is one of the fundamental documents that make up company's financial statement. So now, what are the parts of balance sheet? So the first one is current assets. So when we say current asset, this is the asset that you expect to turn into cash within the next 12 months. Or in other words, this is the cash of the company. So like for example, in current asset includes accounts receivable and inventory. So the second one is fixed assets. So fixed assets is the property or equipment the company owns and uses in this operation to generate income. So fixed assets are purchased for long term or longer than 1 year. So their value decreases over time because of the wear and tear. So this change is recorded as depreciation on the income statement. So So let's note that fixed assets, when we put the fixed assets in income statement, it's always a depreciation. So the third one is current liabilities. So current liabilities, it is also part of the balance sheet. That when we say liabilities, it is a debt or other obligation of the creditors that will be due within the next 12 months. So like for example, current liabilities includes account payable, credit card bills, sales taxes collected, payroll liabilities, and loan payments. So the fourth one is long-term liabilities. So long-term, when we say long-term, it is you pay your liabilities or your obligation or debts that will not be due in the next 12 months. So like for example, long-term liabilities include term loans and mortgages. So the fifth one and the last one one part of the balance sheet is shareholders equity. So shareholders equity. So this is made of common or preferred stock paid in a capital as well as return or retained earnings. So meaning the accumulated company profits that have been distributed to shareholders. Now let's move on. And let me discuss to you what is the current ratio from the standpoint of the investors. So ano nga ba yung current ratio? Ano yung tinatawag natin current ratio para sa mga investors and sa company? So, a current ratio is a liquidity ratio that measures a company's ability to pay short-term obligation or those due within 1 year. So, it tells investors and analysts how a company can maximize the current assets on its balance sheet to satisfy its current debt and other payables. So, now, why is current ratio important to investors? Bakit nga ba importante yung current ratio sa mga investors? So, the current ratio kasi, it helps investors and creditors understand the liquidity of the company and how easily that the company will be able to pay off its current liabilities. So, in other words, this ratio expresses a firm current debt in terms of current assets. So, now, let me sum it up sa what is the current ratio from the standpoint of the investors. So, and why is it important to the investors and also to entrepreneurs? So the current ratio, as I said, it used to evaluate a company's ability to pay its short-term obligations, so those that come due within a year. So the current ratio is calculated by dividing a company's current assets by its current liabilities. So now, the higher the resulting figure, the more short-term liquidity the company has. And that's all for the balance sheet. And the other topics about the balance sheet will tackle about Leia Dagatan.
Good evening, sir. I'm Leia Dagatan, and now I want to explain some questions about balance sheets. And questions number 2: does capital have equity or debt or can it be both? Every business needs capital to operate successfully. Capital is the money used in business, whether it's a small business or a large corporation. Needs and uses to run its day-to-day operation. There are two main sources of capital. Companies rely on debt and equity. Both provide the necessary funding needed to keep a business afloat, but these two have differences. Debt and equity capital both provide businesses money they need to maintain their day-to-day operations. Companies borrow debt capital in the form of short and long-term loans and repay them with interest. Equity capital, which does not require repayment, is raised by issuing common and preferred stock and through retained earnings. Most business owners prefer debt capital because it doesn't dilute ownership. Because equity capital typically comes from funds invested by shareholders, the cost of equity capital is slightly more complex. Equity funds don't require a business to take out debt, which means it doesn't need to be repaid. Debt involves borrowing money directly, whereas equity means selling a stake in your company in the hopes of securing financial value. In questions number 4, what is the implication of the total asset and the total liabilities are not balanced? Then you have one or more of your figures wrong or wrongly classified or wrongly net off against some other figure. There is no such thing as a balance sheet that's not fundamentally balanced. The balance sheet shows the total value of all the assets on one hand and the total value of all the claims, debt holders, shareholders, etc. On that value, on the other, there are different conventions for presenting this information, with some categories of liabilities being net off against related categories of assets, etc. But Fundamentally, the balance sheet always balances. It could well be that total assets do not match with total liabilities and the original equity because the value of assets and or non-equity liabilities has changed in the meantime. In this case, the value of the shareholders' equity needs to be adjusted up or down to reflect the profit or loss that's been incurred so that the balance sheet is correct and balanced. It is indicating that there is an error either in the input of the data onto the balance sheet or the information that has been entered on the tax return does not reconcile with accounting records of the entity. The financial reports are inaccurate. That's all. Thank you, sir.
Hi, I am Karen Rodriguez and I am going to explain about the statement of cash flows. Before I explain the statement of cash flows, I will define first what is the statement of cash flows. The statement of cash flows is one of the financial statements issued by a business and describe the cash flows into and out of the organization. Its particular focus is on the types of the activities that create and use cash, which are operations, investments, and financing. How to use the statement of cash flows? The statement of cash flows can be used to discern trends in business performance that are not readily apparent in the rest of the financial statements. It is especially useful when there is divergence between the amount of profits reported and the amount of net cash flow generated by operations. There are three components of the statement of cash flows. The first one is the operating activities. When we say operating activities, this constitute the revenue generating activities of the business. Examples of operating activities are cash received and disbursed for product sales, royalties, commissions, fines, lawsuits, suppliers, and lender invoices, and payroll. The second one is the investing activities, which constitute payments made to acquire long-term assets as well as cash received from their sale. Example of investing activities are the purchase of fixed assets and the purchase or sale of securities issued by the entities. The third one is the financing activities. The financing activities, these constitute activities that will alter the equity or borrowings out of a business. Examples are the sales of company shares, the repurchase of shares, and dividends payments. There are two ways in which to represent the statement of cash flows, which are the direct method and the indirect method. When we say direct method, it requires an organization to present cash flow information that is directly associated with the items triggering cash flows such as cash collected from customers, interest and dividends received, cash paid to employees, cash paid to suppliers, interest paid, and income taxes paid. The second one is the indirect method. When we say indirect method, the statement begins with the net income or loss reported on the company's income statement and then make a series of adjustments to this figure to arrive at the amount of net cash provided by operating activities. These adjustments typically include the following: depreciation and amortization, provision for losses of accounts receivable, gain or loss on sale of assets, change in receivables, change in inventory, change in payables. And that's all. Thank you.
So hi everyone, my name is Merjo Edolama from Group 2. So let's have a look what is cash forecasting or cash flow forecasting. When we say cash flow forecasting, it estimates the financial position of the business over the specific period of time. And it measured by comparing cash in and outflows of the business. So, what is the significance of cash flow forecasting or cash forecasting with the financial statement? So, the cash flow forecasting is very important because it enables the businesses to make informed strategic decisions. A cash flow forecast is a vital tool for your business because it will tell you if you'll have enough cash to run the business or expand it. It's a valuable measure of strength, profitability, and long-term future outlook of a company. If your cash flow projections shows a weak financial status of the business going forward, you should reconsider making bigger investment in the short term. At the same time, a stronger forecast cash position supports supports making confident decision when allocating cash to new investment because there are enough funds available in the future. So predicting future cash flows also help to identify scenarios where your business will run out of money, giving you the time of proactively prevent that from happening.